Hey, good day, everyone. Welcome to the Bert Salazar Retirement Show. My name is Bert Salazar, and I'm going to be the host for this show today. So I have a lot of very good and exciting information. So I'm not going to take a lot of time from you, but I do want to share some things that are going to be very, very critical as you prepare to retire and as you prepare for 2023 and beyond. So without any further ado, let me go ahead and share my screen with all of you so we can start this podcast webinar. All right, so here we are. This is episode 186. And the title for this episode, as you see there, is Taxes and Qualified Plans. So I'm going to be sharing very good information that you can take yourself if you're someone that does your own that do your own taxes, or if you use a CPA or an accountant, or you use an enrolled agent or a tax preparer. I think it's important that the more knowledge that you have, the better off you're going to be in making certain that you provide the right information at the right time to your financial professionals, so they can go ahead and file your taxes for 2022. So these are things that I'm gonna share that are going to be very important for you. So let's get going on this right now. Once again, the title for this episode is Taxes and Qualified Plans. There are a lot of questions that I receive on an ongoing basis, regarding qualified plans. So I want to share some of those things with you as we move forward into this short, but very, very important and educational webinar. So from time to time, I like to share some of the famous quotes, especially when it comes to economics and tax planning and retirement distribution planning. And this one comes from Ronald Reagan, who was the 40th president of the United States. And he said this many, many years ago. He said that the problem with our tax system is not that Americans pay too little. The problem with our tax system is that government spends too much. And I think we can see that, as I'll show you some of the numbers today. But I think we can see that the US government spending and pilfering away billions and billions of dollars on an annual basis. As a matter of fact, an audit was just conducted of the U.S. government by the CBO, by the Congressional Budget Office, and there were billions, hundreds of billions of dollars of money that have been spent and cannot be found. They don't even know where the money went to. So you can imagine if you were to run your household that way. So it is a fact that it's not that Americans pay too little in taxes, it's that the US government spends way, way, way too much. And it doesn't matter which party you're on. All parties are spending a tremendous amount of money, and they're actually spending money that we don't have. So that's something that I thought would be very important. Now, for those of you that are interested, please go to Amazon.com and pick up my latest book. It's called Retirement Paradigms, Managing Retirement Risk in the 21st Century. And it gives you a tremendous amount of educational information that you can apply to yourselves, to your business, and to your family when it comes to tax planning, investment, retirement distribution, and overall economics. I'm now in the process of writing my second book. But the first book is one that you should be picking up, especially now during the holidays, and use it for yourself or send it to family members that you love and care for very, very much. So now what I'd like to do is I want to share some of the topics that we're going to talk about today. The first one is I'm going to cover the national debt in 2022, but also fast forward another 5 years and what it's going to look like in 2026. I'm going to share that with you. Also, we're going to talk about required minimum distributions on qualified retirement accounts, IRAs, 401ks, pensions, and so forth. And I do get a lot of questions along those lines, so I'll try to answer some of those questions for you as well today. I'm also going to share how it is that RMDs work. When are you eligible for RMDs, and what is the process for you to use RMDs? and the good and the good, the bad, and the ugly when it comes to required minimum distributions that all of you are going to be impacted at some point in time in the future if you were making or you have made contributions to qualified retirement accounts. And then we're going to talk a little bit about the tax impact of qualified plan distributions to you and your family. And then last but not least, what's a perfect retirement plan? There is a perfect retirement plan. I'm going to share that with you. The vast majority of the clients that I engage for the first time are so far away from creating a perfect retirement plan that for many of them is going to take a tremendous amount of catch up and changes in order to accomplish perhaps even 50-60% of what a perfect retirement plan should look like. Now, if you have 10 years, or if you're 10 years away from retirement, or you have 10 years before you're going to start exercising your retirement distribution plan, then there's a lot of work that can be done, and you can accomplish a perfect retirement plan. So I'll share those with you fairly quickly. So let's get now to the 22 national debt. Now, this is something that you can pull out of the U.S. debt clock, and there are a bunch of numbers there. Obviously, I'm not going to cover all of them, but there are a couple of numbers that I think is important that you take a look at. The first one is on the top left-hand corner of your screen where it says U.S. national debt. And as of the month of December in 2022, is sitting at 31 trillion $330 billion. Now, that's an enormous amount of money. And by the way, this debt clock gets updated every single second of every single day of every single year. So that's an enormous amount of debt. If you move further to the right, you'll see U.S. federal tax revenue. This is the amount of money that the U.S. government is bringing in-house every single year through taxes, investments, and other things that they collect money on. And that one is sitting at $4.9 trillion. And if you go back to where the U.S. national debt was on the left-hand side, if you just move down one line, you will notice that the federal spending, the official federal spending for the U.S. government is at $5.983 trillion, almost $6 trillion. So think of it this way. We're bringing in $4.9 trillion of revenues, but we're spending almost $6. So we have a deficit right now, almost $1.1 trillion. As you can see there to the right, the $1.081 trillion. So obviously somebody's going to have to pay for that, because we're actually spending more money than the revenue that we have coming in is allowing us to do. So we have to borrow more money, and that means that future generations are going to be in trouble. We, as a generation, are going to be in trouble as well, because taxes are going to have to go up, because otherwise we're going to have to go bankrupt. And that's not something that the U.S. government wants to do. Now, something interesting, if you go a little bit further down from the federal spending debt of 5.9 trillion, take a look at the percentage of federal debt versus GDP ratio. That's the gross domestic product. And if you look back in the 1960s, it was just north of 52%, the debt to GDP ratio. If you go into let's say in the year 2000, we're sitting at 55.3%. So the debt was representing 55.3% of the overall GDP ratio. But if you go to right now in 2022, we're at 121%, almost 122% of GDP ratio. So we're actually spending a lot more money than what our country is able to produce. And that's very sick. The last number I want to share with you, and try to remember these numbers. Remember that, we have $31 trillion in debt. We have a $1 trillion in national deficit. We're now sitting at $121 trillion or 121% of debt to GDP ratio. And then at the bottom right hand where it says US funded unfunded liabilities, it's $173 trillion. The US unfunded liabilities are basically the debt that we have today, compounded annually, plus all of the promises that the US government has made to all of us that they don't have the money to keep. In other words, Social Security, Medicare, Medicare Part D, and obviously the interest on the national debt. You're going to start noticing that now that since the interest rates in the United States have been creeping up for the last 12 months or so, that means that, for us to be able to service the national debt, meaning, what is it going to cost for us to pay for the debt? It's going to continue to go up because now we have to pay at a higher interest rate. Very briefly, let me cover what 5 years from now would look like, and this would be in 2026. So notice that now the national debt went from 31 trillion to almost 42 trillion. And then the deficit has gone from just north of 1 trillion to almost $1.6 trillion. And if you look a little bit further down, notice that the federal debt to GDP ratio is now 147% as opposed to 121% in 2022. And then take a look at the unfunded liabilities at the bottom right-hand side. We went from 173 trillion to a whopping 219 trillion of unfunded liability, and we don't have that money to pay for. So we're going to have to raise taxes very quickly. And those of you that are investing in qualified plans are going to be paying dearly because you've been saving money at lower tax rates. In other words, when you put money into a qualified plan, you put the money on a pre-tax basis, the money grows tax deferred. But then when you pull the money out in retirement, you have to pay taxes on the entire thing. Not only the contributions that you made to the plan, but also the growth and the interest that that plan has earned on your behalf, for many, many years. So, those are things that you got to pay attention to. So, you got to start thinking about if the vast majority of your retirement accounts are accounts that are going to be fully taxable in retirement, now you're going to be forced to pay those taxes at a much higher rate. So there's a lot of things that you can do along the way, but obviously this is something that you need to pay attention to because as taxes creep up, that means that you're going to have to take more and more money out of your qualified plans in order to maintain your standard of living on a net basis, because at the end of the day, it's not how much money you take out, it's what you net after you pay taxes to the US government. So let's go a little bit into required minimum distributions. For those of you that may not know this, when you put money into a qualified plan, you all know that you cannot pull money out until you're at least 59 and a half, because otherwise you're going to have to pay a 10% penalty for premature distribution. Now, there are ways that you can take money out. Obviously, if you have a death or a disability, the IRS is going to be waiving the 10% penalty. And then obviously you can do systematic withdrawals, based on your mortality and so forth, and then avoid the 10% penalty. And there's a rule for that, which is the 5-year rule, or age 59 and a half. So we're not going to get into that one right now. But what's important to note is that up until maybe 3 years ago, between 59 and a half and 70 and a half, you had the ability to pull money out of that plan at any point in time and no penalties. Yeah, you still had to pay the taxes, but you had no penalties. Now, the government and the Trump administration went ahead and extended via the Treasury and the IRS rules, they extended that required minimum distribution from 70 and a half to age 72. So the rules that we're living by today basically says that prior to age 59 and a half, You should not take any money out of your qualified plans. Otherwise, you're going to have to pay taxes plus a 10% penalty. And then at age 72, you have to start taking money out of your qualified plans. So you have that window between 59 and a half and 72. You can do whatever you want. At age 72, you have no choice but to start taking money out of your plan, because the IRS is now looking for taxes on your retirement accounts. And if you fail to take money out of your retirement accounts at age 72 and in latter years, then not only are you going to have to pay taxes on the amount of money that you should have taken that you didn't. I'm going to show you how to calculate those formulas, but also you're going to have to pay a 50% excise tax penalty on top of that. So if you needed to take $10,000 out of the account and you're in the 25% tax bracket, that means that if you don't take that money out, the 10,000 is going to be taxed at 25%. So that's going to be $2,500 that is going to go to the IRS. And on top of that, that same 10,000 is going to have a 50% excise tax liability, which is going to take another $5,000 out of those 10,000. So in reality, out of the $10,000, you're going to net 2,500, because $7,500 of those dollars went ahead in taxes and penalties and went away in taxes and penalties to the IRS. Now, if you find yourself at age 73 and you forgot to pull your age 72 income out of your required accounts, then obviously make sure you talk to your accountant right away, or feel free to give me a call and I can help you, hopefully help you avoid that 50% excise tax penalty. Now, let's get into how RMDs work. So when you get to age 72, in the year that you reach your age of 72, you have to go back to December 31st of the previous year. So if you turn age 72 in 2022, you would have to take a look at the value of all your retirement accounts as of December 31st, 2021. And then in this example, let's say that the value of all of your accounts as of December 31st, 2021 were $500,000. You have a $500,000 account balance. Well, based on your mortality withdrawal percentage at age 72, the IRS tells you that you must take 25.6% out of your $500,000 account value in order to meet the IRS required minimum distribution, or RMD, and avoid paying any tax penalties. Now, you can always take more, but in this situation on $500,000, this client would have had to take $19,531 out of his or her account in order to meet the RMDs. Now, that's important to note, because as your account values continue to grow, then obviously you're going to have to take more and more every single year. And also as you get older, since you're getting closer and closer to that mortality age, then the IRS will, force you to take more, but at a lower percentage, as you will see in the next few minutes. So it's important that you understand that. Another point that is very critical when it comes to RMDs, because I have had a number of clients that have come to see me because they got into trouble for not knowing the rules of engagement, is the following. If you have, out of the 500,000, let's say you have 250,000 in a 401k, and you have 250,000 in IRA, you have to do two separate calculations. You have to take a look at all the money that you have in your 401k, and then use the 25.6% withdrawal for that 401k, and then the $250,000 for all of your IRA accounts. You have to go through the same exercise and take the 25.6%. Now, if you didn't have a 401k, so let's say that the entire $500,000 was inside your IRA accounts, then it's a lot safer for you because the 25.6% will apply to the entire value of the 500,000. And another very important point is that if you have 5 different IRAs and you have 100,000 in each IRA for a total of $500,000, the IRS doesn't care where you take the $19,531 from. The IRS will allow you to lump sum all of your IRA accounts, and then you can decide which accounts you're going to take that money from. So let's say that out of the 5 accounts that you have, 5 IRAs, you have 2 that are not performing well and the other 3 are doing well, then you may be able to take the entire R&D from those 3 that are performing well, and then allow the other 2 accounts that are not doing well to kind of recover and hopefully do better in the future. So you have to understand the rules. It's not so much the fact that you need to know how much money you have in your account value, retirement account values as of December 31st of the previous year, but you must also pay attention where those monies are invested and where those monies are deposited in order to determine that you're following the rules of engagement when it comes to taking money out of pensions or 401ks versus traditional IRAs. So I hope you understand that because it's very, very important for all of you. And then along those lines, if you don't know when you're going to die, the IRS does. So what the IRS has done is that they have come up with what they call the uniform lifetime tables that will tell you at every age how much money you have to take out of your retirement accounts or what percentage you need to take out. So for instance, if you are age 72, as you see there on the table, notice that to the right of that, the distribution period, which is basically the years that you have until mortality based on the IRS code, is 25.6, which is the exercise that we covered in the previous slide. But then when you get to age 73, look at now you have you're closer to mortality, so now it's 24.7, then 23.8, then 22.9, and so on. So every single year you need to understand, you need to know what is the amount that you have to take in order to avoid penalties. Now, most financial institutions are going to send you an R&D letter, once you hit the age of 72, and they'll tell you what you need to take out of each and every one of those accounts that they're holding on your behalf. But those individual investment companies don't know everything that you have. So you are the one that is totally responsible for making certain that you have done your due diligence and that you have made the right decision, because otherwise you are the one who's going to pay the penalty on those accounts. So that's important for you to note as well. Now, as I proceed to finish this short podcast and webinar, many of my clients always ask me, Bert, how can I get my retirement distribution plan better? How can I avoid, making mistakes that is going to cost me and my family, hundreds of thousands of dollars in retirement, and that's something that we cannot afford as Americans. You cannot afford it, neither can I. So over the years, I have created what I consider to be a perfect retirement plan. And here it is. I'm going to kind of share this one with you because it's important for you to see it. Number one, if you want to have a perfect retirement plan, you have to have guaranteed paychecks. Because one of the biggest challenges that our Americans have is they have no idea how long they're going to live and when they're going to die. So if you have X number of dollars in retirement and you're planning for your retirement distribution plan, you have no idea how long you're going to live. So what you need to do is you need to create a retirement plan where you're going to have a guaranteed paycheck that no matter what happens, that paycheck is going to keep coming in for you and your family, similar to a pension benefit. You also need to make certain that those paychecks have longevity protection, because you may live a very long life. And if you do, you don't want to run out of money before you run out of life. So having guaranteed paychecks that can also continue to come until the day that you die, and so having that guaranteed with longevity protection is going to be very, very important as you move into your retirement years. And you need to prepare for that prior to reaching retirement, because there are a lot of different options that you can pick and choose depending on your individual circumstances. Those same guaranteed paychecks that now may have longevity protection, they also need to have inflation hedging, as you see there. Why? Because you want those guaranteed paychecks to continue to increase, to either stay with inflation or stay ahead of inflation. So having guaranteed paychecks, longevity protection, and inflation hedging is paramount for your retirement success. Also, you want to have tax-free income. And the reason why you want to have tax-free income is because since taxes are going to be so much higher in the future than they are today, you want to try to avoid paying taxes in the future. Because if you are waiting to pay taxes in the future on all your retirement accounts, what you're going to realize is that as taxes continue to go up, you're going to need to take more and more. And because of the fact that you're taking more and more money in retirement, that's going to accelerate you running out of money before you run out of life. So it's a way to hedge all of these different things for you and your family in the future. You also need to have long-term care hedging, because the longer you live in retirement, and this is according to all the statistics, 70% of Americans in retirement are going to have a need for long-term care. And long-term care is very, very expensive. So that means that now if you're in retirement and you have a long-term care illness, and now you need care, or you need to go into an assisted living facility or in a nursing home, that's going to be increasing the overall cost and the impact on your retirement accounts. And by the way, Medicare does not cover long-term care. And then finally, you need to have survivor benefit protection, because you want to make certain as well that if you happen to be married and you pass away, you want to be sure that your surviving spouse will continue to maintain that income for his and her life. So when you look at all the strategies and the 6 strategies that I use with my clients in order to create the perfect retirement plan, as you see there, is making certain that you have guaranteed paychecks that are going to be coming to you every single month for as long as you live. You could be 120 years of age and still have a paycheck coming to you. That those paychecks have an inflation hedge and they continue to go up every year. That they're also tax-free, because that's going to be an enormous benefit for you and your family. And that they also have long-term care hedging in case you have a long-term care illness, and that your family, after your passing, will enjoy that survivor benefit protection. So that is what a perfect retirement plan should look like. Now, for those of you that may want to explore some of these topics that I've talked about today, please feel free to reach out. You can call me at area code 305-304-4770. You can also send me an email at Bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And as I always say let me just take you off of here. As I always say to all of you every single day, my goal for all of you is to kind of help you, change in the way that you see things. Because when you change the way that you see things, the things that you see change. So once again, it's 2022. We're in the holiday season. Merry Christmas, Happy New Year, Happy Holidays to all of you. And we'll talk again soon. Take care. Bye-bye.